All right, everyone. Welcome back to Money in the Tank, episode 46. You got me, Arnie, finance professional, and
Brad, generalist startup guy.
yeah. So thanks for tuning in. We're Sans jolly this week. He's out having a bit of a bash with the golf club, so we're going to take over the reins. And if you want to get us at Money in the Tank, it's at Money in the Tank on YouTube, Twitter, Instagram, Facebook. Please give us a like, comment, subscribe, because that will helps us out immensely, and we love engaging with you. So we're going to discuss about interest rates today because that's the hot topic, as seems to be. I think we've done about 4 or 5 pods on interest rates now, Bradles.
Yeah, well, when they're going up as fast as they're going up,
It's
75 to 100 basis points at a time, I think, especially in the current world with a few storms going on, I think, interest rates are that thing that everyone kind of goes, well, is it going to be the kind of the pin that pops stuff, right? And so far, not. And we are seeing kind of, is it going to be a soft landing, a hard landing, all those kind of terms. But I think, because a lot of people that probably listen to us and ourselves own homes, obviously interest rates matter. But I think the speed of interest rates kind of rising and the lack of them rising early enough is the reason why. Hot topic, right? Everyone's on it.
Well, it touches every part of the financial landscape, and obviously we're concerned with investment, and that's a massive part of it. So, yeah, we're going to talk about that again today. Surprise, surprise. And but before we do, you've got a Rivkin's Rules quote in Jolly's absence.
I do. I've actually got two.
Oh yeah, 2 for 1. Love it.
2 for 1. So my first one is from the great man himself. I was actually pretty impressed with these that I found, like of him saying these words today.
Okay.
So the first one is, unless human behavior changes, in brackets, and it won't, fear, greed, and folly will always drive markets. And I thought that was very
Fear, greed, and folly will always drive markets. You know what? I don't know if I agree with that, but let's hit the second one, and then I'll come back to that.
See, I totally agree with it.
Okay.
But obviously, folly, we'll come back to it. The second one is a very nice one by our dear man. And so I think one can achieve a very pleasant lifestyle by treating selling human beings very well.
I absolutely agree with that.
And on that one, I'll just make my comment is while I was a program manager at NAB, I've always felt like, I don't know why everyone around me doesn't get it, that if you just treat people well, then you will have a happier time working and you'll get better results, as seen by like a team of 30 or 40 getting what 140 people used to. And then when we started Hammer Tech, all kind of the original 5 founders said that. Now we're going up to 100 people, and it shows again, like, you just treat people well, whether it's in personal life or business life. And what do you know? And it's so crazy, like, especially being, like, say, in the startup world, just looking at other companies and seeing how they treat people, even during these hard times, because when it's hard times that it matters, right? Everyone can be nice when money's flowing and everything's happening. And you just see, like, how you don't treat them like humans and with respect. And you're like, how are you expecting a company to be successful? So, yeah, anyway, great, Rivkin.
I 100% agree with everything you said, and I agree with Rivkin on that second point that, like, if it's professional, the relationships you have with the people around you and your managers are critical. And when everyone feels appreciated and happy and like they're doing a good job, or if they are doing a good job and they get told they're doing a good job, it goes a long way to, inspiring people to do their best work. And then in your personal relationships, obviously you want to get back what you put out into the world. You want to be nice to people so they're nice to you. Otherwise, they're not going to associate with you. On the first point, though, that he made about fear and greed and folly, I think, and I guess I'm viewing this through the lens of investing. I do think that greed is what motivates people. Like, people want to make money. So I don't disagree with that part of it, but I do think that there's been a shift in recent times towards things like ESG, which we've done a podcast on, and people are very mindful of where they're putting their capital and how that's going to affect the world. And I think that's why you're seeing the rise of companies like Tesla, like anything to do with renewable energy or that's going to sustain the future. It's basically people voting with their dollars. It's the way capitalism
would you say,
should
Arnie, work. Fear, greed, principles, and folly drive markets? Because Rivkin probably wrote this in the 90s, and there probably wasn't too much ethical values put into investment choices. And you do have people, like I said, I've put my whole super, obviously super is just a smaller part of my overall net wealth from my days at NAB and the rest of it, but I put my whole super that I have into kind of like ethical funds because I was like, well, I'd rather that work long term on large scale infrastructure projects that obviously, hopefully, return a good result as well because I believe bullish on that. But it was, part of it was around the principal side of things.
Maybe the way you frame that maybe changed my mind. Maybe it is fear and greed, and I don't know about folly, but maybe it is fear and greed that's motivating
folly
us.
Last year, right? If you think about folly, like as in terms of a lack of good sense, foolishness. Last year or the year before that, tell me the last couple of years in the market didn't feel like folly with what was going on around us.
Oh yeah, there's a lot of folly. All right, yeah, no, you got me. Okay, we agree with Rivkin. That was a good sounding out of.
But I think we can throw principles in there. I think we can throw principles in there.
Yeah,
or ethics. But I think it's the first point though. Going back to it really quickly and not to spend time on it, but like treatment of human beings, it's just again something that I just don't understand because it's so simple and everyone talks about it, but no one actually just does it. Or they do it, put in practice, or they do it, and it's like textbook.
Yeah, or it's fake. Like they're just doing it
absolutely
because,
fake.
like, you want a genuine connection.
Yeah.
Anyway, we're straying. We're getting into like this is philosophy now.
This is what me and Joel do. This is what Joel, maybe I'm the guy that goes deep. Damn it.
I like it. I like when you wax lyrical about these deep topics. It's more.
Me and Joel always come off thinking that we're like philosophers. Probably why people drop off at that point. So let's keep going on to the I guess the big news, right? Which is Fed 0.75. I mean, 85% of economists thought they were going to go harder on it due to the August kind of inflation rate sitting around 8.3%, which, with energy coming down due to, Biden obviously touching the strategic reserves and the rest of it, probably higher than planned. They kind of thought it was going to start coming off a bit. And so, Powell's obviously come out and hit the 0.75 and markets have kind of reacted. We'll talk about that in a second. But what are your thoughts, Arns, on both that and I think you had a couple of comments around what Powell's also said around kind of where to from here.
Yeah, I think. What do I think about it? I think I still think the Fed is doing the same thing they've done the whole way along, which is they're not going hard enough when they need to go hard. And like even though it's an interesting one because they're looking at backwards looking numbers, they're looking at historical rates to guide them, and then like as we see the new information come out, they're going to see if what they're doing has actually taken effect. So I do think that they needed to raise. 0.75 is obviously a significant raise, but I almost feel like why didn't you do one? Why didn't you do 100 basis points? Because I just feel like they need to. They're going to get there anyway. Why not just nip it in the bud and do it? And then
with last month's August figures. And and this is one of the positives about the US and EU. And I mean, me and Joel covered the laughing stock of Australia not getting monthly inflation, like CPI information.
Yeah.
But I think August showed that the response wasn't there yet. And so one of that bit, like if you're thinking like I'm with you, Arnie, which is if Powell said, okay, well, this is what we're doing for the rest of the year, maybe 2 months ago. And we're going to look at the rates. And then August did that. To come out and go, well, August didn't do what it is. We're going to begin there anyway. So here's a 100 or 125%, 125 basis point increase. Yes, because it might scare the markets. Because, the markets would have a meltdown. But I think what the Fed's always done, like, in my opinion, is they're continuing to try to play that.
They're trying to thread the needle.
And you had a time to thread the needle if you started last year.
Yeah.
You started in April this year.
Yeah.
You don't have time to thread the needle.
That's right. Yeah, because what you were saying, like I know that they've said that they're going to get to 4.4% by the end of this year, which means that the next two meetings, the November and December meeting, it's going to be another 0.75 and a 0.5. Roughly.
And he came back out and reiterated that 4.4 by the end of this year and estimated 4.6 by the end of next year.
Yeah, which means it's like over the course of the next year, there's room to do another 0.25 on top, and then if they need to, they'll go higher again. But
and you just got to remember there was only 3.8 at the end of next year, only 4 months ago. So these are moving figures, but they're committing to 4.4 by the end of the year, and that's only 2-3 months away.
Yeah. So why not do a bigger chunk this meeting? Exactly what you said, and then I think they're also forecasting that will be coming back down to 3.9 by the end of 2024, and then lower again, I think, into the 2s around 2025. That's what they're saying. So Powell has said...
When are the midterms?
I think they are November this year. Is that right?
Yeah. So my guess, this is just me,
Yeah.
living in America for 5 years and seeing at the moment my friends and colleagues' commentaries of all this stuff. We probably in Australia. I mean, look, I'm just personal opinion. Not going to comment. I'd love your opinion here, Arnie.
General in nature.
General in nature. I mean, we don't necessarily politicize that much rate cuts. We do look at, obviously, we look at the Reserve Bank of Australia as being a neutral, it's tied to the government, physical policy. They try and do monetary policy. Obviously, there's kind of oversight, some kind of, there is that. But when the Reserve Bank did a rate rise ahead of the federal election, let's just say that, it surprised some of us. We're like, okay, well, they're really being independent. They're actually doing what they should be doing.
Yeah.
In the US at the moment, the rhetoric around oil prices, inflation, everything like that, the politicizing of it because of midterms coming up is out of control. It's like, Biden at the moment, I'm not left or right, everybody, just kind of just playing and putting it out there. But, this stuff that Biden's getting an absolute kick for putting out the emergency 1 million barrels of oil a day. But then he's getting absolutely reamed about oil prices being too high. But then he's getting absolutely reamed about Saudi Arabia not increasing it anymore. Then he's getting absolutely reamed about pumping too much money into the economy when it was both left and right who pumped money into the economy. And so everything over there is politicized. It doesn't matter what kind of decision is being made. And I just think that the Fed, in a way, is playing politics, which is like if they did a 1.25 or 1.5 and there was some hurt and say the stock market reacted as it would, I think then, that would rub off badly in the midterms and the rest of it. So there could be, that's just my opinion, there could be some
pressure there.
Some pressure there, which is kind of like, okay, you can get to 4.4 by the end of the year, but you do it in a timely fashion and don't spook the markets before the midterms. Otherwise, that's playing into politics. And that's the crazy bit that we're in at the moment is politics is so tied to some of this stuff at the moment, whether it's food prices, energy prices, all over the world. And you're seeing like so much pressure on kind of our traditional institutions and governments. It's an interesting time.
The skeptic in me believes what you just said. I do think that's probably what the case is. Yeah, like if you actually were to pull back the curtain, there's probably pressure there on Powell and the Fed, and that's probably why they've done it this way. When everyone's screaming at them to go harder, but
everybody's screaming at them to go harder. And if you think about it, what the next rate rise will be, or the next rate rise will be this time October.
November won't. I think it'll be November, or maybe I'm wrong.
Are they monthly?
No, they're not weird timing on. Let me have a look at it. I'll Google it.
So look, next
meeting 2022.
Anyway, it's first.
Well,
let's have a look. But I was going to say September. But then when's it after that? What do you got, Arns?
Oh, I didn't. I stopped looking.
You go, and I'll have a look.
I got it. So yeah, it's November. It's November 1st and 2nd, then December 13th and 14th.
Oh, so when's the midterms? It's going to be November
late November, isn't it?
So there's going to be one more
before then, which will probably be 0.75, and then another 0.5. But I was going to say that Powell also it's
November 8th, mate. So that's the thing. They might. I reckon like this one they have to go whatever on, and next one.
Well, you think they'll do a soft one on the next one just before?
I think they'll be soft.
Like a 0.5 at the next one, you reckon?
0.5, and I'll say they're just waiting, and then they'll come in hard afterwards.
That's interesting.
It's just like Powell. It's just like Powell saying transitory, so that he keeps his job.
Yeah, I mean, to be fair, at that point in time, before we had the war issue break out, if the supply side issues had a fix, which is, I think you and I both agree, not everyone agrees on this, by the way, that's long term, the only way to solve this inflation crisis is to fix the supply side issues. And that doing this like rate rises is going to, cause demand destruction, and it's going to stop people, spending on like frivolously. They're going to need to reserve their money for things they need.
But truly,
that's only going to fix it in the short term. And then once you cause a recession, which is what they're trying to do, and people come out of the workforce, it's basically just prolonging the pain. Like if you haven't fixed that supply side issues at that point in time, and then you cut rates, inflation is just going to come back. So,
and there's no precedent in history, in the whole of history. Fun fact, don't know if we covered it before, but we've never been in a recessionary environment where rates are getting risen.
Yeah, exactly.
I mean, the traditional thesis is recession needs to stimulate growth, therefore cut rates, right? And so, again, I think that point just backs up that a large amount of the inflation is, and even with Russia, that a large amount of inflation is being caused by still infrastructure and supply chain issues reverberating. And some of that's going to be infrastructure getting built, some of that's going to be new supply lines, some of that's going to be geopolitics, some of that's going to be whatever, and that plays out. But if we're in a high interest rate environment, when jobs getting cut, like, I know that one of you articles, Meta cutting 10%, but I think, you've got nearly every company that I know cutting, like, especially in, like, say, the startup world, 10-20% of workforces blanket at the moment, preparing for a tighter environment. And so it's going to be an interesting one. And I think, from the rates, I guess the stuff that I wanted to throw up, I don't know if you've got any other comments.
Before you do, I'll just say one more thing about Fed. So Jay Powell did say that he thinks that they are currently at the lower end of their restrictive policy.
That's right.
So that means that they could go a lot harder if they need to. And the other thing they also mentioned was that they are still, they reiterated what he said at Jackson Hole. They are they're high. I think he said they're highly attentive to the inflation risks. So,
and that is one thing. So at least they're now saying, because they've got two mandates, like everyone knows, which is jobs, inflation, and threading the needle means trying to get both basically as good as they can be. And he reiterated again that inflation, I mean, that's probably the positive for me, is that he seems to be locked on that inflation is the problem and needs to be fixed. Again, how we go about it and how much can be fixed by raising interest rates, we'll see. But that's the other thing that people have to realize is that the central banks only have one tool. They've only got interest rates. And so when people will ask him, what's going to be happening with house prices, all the rest of it in terms of over our end, at the meeting, I think it was last week, the Parliamentary Committee about rate rises here in Australia.
Yeah.
And they'll ask him about property prices and how much he thinks he's going to get. And he's like, that's not a mandate. We've got two things, which is jobs and inflation, and we've got one tool to do it. So, it's not a job that I would be envious of at the moment.
No way. Difficult.
And then you are absolutely responsible for what happens to the entire economy. And everyone looks at you like, why didn't you do it earlier? Why didn't you do it too much? Why didn't you do it enough? And so remember that we are humans, and that's why anyone that can forecast where they think the markets are going are a liar. So what I want to throw up was just a bit of and for our YouTube or video listeners.
Yeah, so for anyone watching or anyone who's listening, I should say, Brad's just throwing up some interesting global central bank policy rates and what they're doing around the world.
Yeah, and I just thought this was just interesting to kind of, obviously it's about, I don't know, I'm going to take just about 25, you reckon? Maybe 30 countries up on this list.
Yeah, about 30, 40, yeah.
Yeah, and, it ranges from the central bank rate, in, say, Denmark and Thailand at around 0.75%, all the way down to Argentina, 75%, but really the one above Argentina is 13%, being Brazil. And then your CPI year on year, ranging anywhere between kind of 1.9, I think was the lowest, up to 80%. I think Turkey's the highest at the moment, closely followed by Argentina at 78. I wouldn't want to be there at the moment. And then just kind of a bit of an idea about where the real central banks rates are today. And kind of seeing where everyone's at and then what their last move was. And other than Japan, which is still a negative interest rate, which is amazing. But I mean, they've been in that kind of stagflation environment for 20 years.
Yeah.
You've got China, who is trying to stimulate growth. And so every economist that actually is looking at China at the moment, whether it's from their 31% fall in new property dwellings, whether it's to do with their trade balances, all the rest of it, they're in a recession at the moment. And so they're actually in an environment that is not got bad inflation, and so they're cutting rates at the moment. Obviously, you've got Russia who's playing a bunch of stuff they're cutting, and then Turkey's doing reverse economics with Erdogan economics and cutting, but everyone else is hiking. And it just seems everyone's moving back to that kind of that 4 to 5. The majority of people are moving back to that 4, 5, 6 range with people on the outside. But it is something that is global. And that's kind of like a reason why I just wanted to throw that really quickly, is not necessarily to talk about the outliers or the good news, the news stories there, but just kind of going that everyone's hiking, everyone's moving it towards this bit. And I think we've got a ways to go as, you look at people's inflation numbers across the board. And if you kind of average it out, it's probably, take out the outliers, it's probably sitting around the 8%, right? And it shows that, like, it isn't just, a cheap money or too much money out there problem. Because a lot of these countries are secondary or third countries to the US dollar. Not all of them printed money during during COVID and the rest of it, and so there is got to be a huge supply.
This is the thing, right? Like, this is the argument I've had with people or discussed about this exact issue, is that, like, when people say it's a demand problem, I don't think you or I would disagree that it stems from a demand problem.
Yes.
Because you've got the money printing and
40% money printing. Correct.
Yeah. In Australia or the US or any of those, like, Western countries that did a lot of it, that's obviously where you're going to spur the demand. And then where are those supply chains located that go to meet that demand? They're located, in places like China or India. And when you've got this, like, I guess, domino effect of supply chains getting locked up, and then you've got the energy, the shock from the war, coupled with that, and then you've got COVID, which is taking people out of the workforce, which means they can't get back to things like, the shipping or the ports or whatnot. It's just this domino effect. And even so, yeah, when people talk to me about this, they say, how can you say it's a supply problem when there's evidence that we produce more goods than ever in, like, multiple industries, in last year, 2021. So, we're clearly, it's not a supply problem because we've got more than ever. And I'm saying, yeah, you've also got it just takes one element of that supply chain to break down. And then you got lags and you got, whatever's going to happen, shortages or oversupply or whatever. So
I think the easiest way to kind of look at it, and not bang on it about too much, but the easiest way to look at it is we've been used to, for the last 20 years, just-in-time supply chains. And that's why we've got prices where they are. And just-in-time means that basically every part of that supply chain works efficiently, and we get our product. The product's always on the shelves, and they get the product. They don't want to hold stock because holding stock costs money and the rest of it. It just-in-time arrives. And so when you go into the store and suddenly, there was lettuces $10, or there was, I know that was to do with floods, but if your lettuces, or I have to wait 5 months for a piece of furniture, or TVs at the start of the year were 4 months, or cars, brand new cars,
graphics cards.
All you have to wait is for one thing in that supply chain, not two, or chips, one thing in that supply chain to not match what everyone else is doing, and it throws it out. And so if I was a guess, I think we're going to go too hard one way, and then it's probably going to go deflationary. That's just my my guess. But just quickly talking about, because we talked about before how rates touch everything. Just some quick kind of just to show that, I guess, that flow of what it touches, and make sure that everyone's aware of kind of all the different facets that rate rises kind of impact. So the ASX has kind of dropped to a 2-month low. Wall Street sinks ahead and continues to sink. The RBA is now facing a big loss from the emergency stimulus. This one was interesting, I thought, which was the Reserve Bank revealed that its $300 billion pandemic-era bond buying is now going to cost them another 35 to 58 billion due to, obviously, higher interest rates. And the difference on bonds around that. So that was an interesting one. Little room for optimism, standard kind of journalism there. That we'll throw this in. Again, I'll always come back to my point, which is they'll never say anything until we're in amongst it, and then they'll start saying stuff as we're working through it. And we weren't in a recession last year. I think the global economy is in a recession now. And it's going to work its way. Does it get worse for a while? What needs to happen to get it out of start unwinding, right? But the journos love to throw out a thing out there. But I think the Australian dollar at the moment is an interesting one to watch. So, I've got a bunch of mates here in Australia that are American, and they're always asking me, should they be bringing over more money now, less money now, etc. I'm like, anyone that can tell you that is a is a genius. I can always just give you an opinion. But just so people understand that if one country, let's say America, continue to raise interest rates, and therefore, if you put your money into an interest-bearing account or bond, it creates a demand for the US dollar. And if Australia doesn't, then there's less demand for the Australian dollar. That's one of the reasons why people buy currencies of countries, and is to buy things like bonds or deposits. And they believe, one thing people believe, that due to the Fed's kind of 0.75, it's going to put pressure on the RBA, because the dollar hits a 2.5-year low against the US dollar. It now seems more than likely not the RBA will lift rates by 0.5% in October, depreciating, because the depreciating Australian dollar is another reason why the central bank would opt for such a large move. Further declines would add to imported inflationary pressures. So basically, as our dollar goes down, it costs more to buy the same product from America. And then that then reinforces the inflationary, because we do import a lot of goods from Australia.
From America,
From America, sorry. The upside for Australia, because there's always an upside in everything, is that as our currency weakens, our exports become more competitive on the global landscape as well. So there is always two sides, but for things like, for some reason, even though we do produce so much resource and the rest of it, we still import refined resources and goods. We like to dig things out of the ground, send them overseas, get them refined, and then buy them back. And so as a country, and so watch out for that. And also, I think, Arnie, you're talking about investing as well for the currency.
Yeah, well, like as you were mentioning, Brad, like if you haven't already got US dollars sitting there and you want to invest in that market, well, every time the US raises rates and we don't follow suit, or we don't follow suit as strongly, it means it's going to be more expensive to convert your Australian dollars into US dollars. So, or conversely, if you've got US stocks that are doing well and you were to bring some of that money home, you're going to be getting bang for your buck when it comes from US dollars to Australian dollars. So, general in nature, I'm not saying do one or the other. It's just something you're going to have to manage and track as part of your investing portfolio, is what's happening with your FX movements and changes. So,
and that's one thing I'll just kind of touch on, that for anyone ever looking to do a startup and the rest of it, and as you're traveling, your journey, when there is a time to diversify into other economies, do so. So, we started Hammertech back in 2014, and 2016, 17, we were in a place where it was probably too early, but we decided to do it anyway and diversify, because construction is a very cyclical kind of boom bust kind of industry. And we thought, well, as long as one's booming, the other one might be busting. And that decision now is paying off. Because as Australia goes down, which was where our kind of our main money was being made, our growth is in the US, and at the moment, you've got that side. So Australia helped us during COVID,
yeah,
because Australian construction stayed open, America shut down, and then vice versa. So just another reason for diversification, everybody. And then I think it's just tying into, I guess, the story of rates, currencies, demand for Australian products. I just saw that a 31% fall in new residential housing sales in China indicate a rapid slowdown in new construction and steel demand, and iron ore. And since Australia is still a huge, huge, huge exporter of iron ore to China, that again will be less demand for the Australian dollar. Yield curves, Arnie?
Yeah, so I was going to touch on it in news, but we may as well talk about it now. Is that I saw that the 10 and 30-year yield curve had inverted, and I think you, just before this pod, you mentioned to me that you've been tracking it, and the 10 and 2 has inverted as well. So as of when I looked at this, which has probably changed now, it would have changed by now. The 10-year yield was 3.56 and the 30-year yield was 3.52. Meaning that you can get a better yield on the 10-year instrument than you would on the 30. And normally, tankers, you would see a better yield on the longer dated instrument because you're holding it for longer.
And that I guess that when we say inverse yield curves, we're not trying to speak some funny language. Just literally the reverse to what the yield curve usually happens, which is just the longer you hold it, the more interest you get on it. And what that generally an inverse yield curve indicates is that a recession is imminent, or we're currently in it. And on the screen at the moment, you'll see that the 2-year yield actually went over 4%, when the 10-year was at 3.6. So
that 10-2 is a particularly sensitive one that people look at, not just for a recession that Brad mentioned, but also when they're predicting a crash. And in every instance of this happening throughout history of markets, it's always been followed by a crash. So I'm not saying it's going to happen now. This is general in nature, but it's just that is a powerful indicator that we look at.
No, 100%. And just to add a little bit more spice and herbs to the recipe at the moment. And look, this is not negative news, guys. It's just updating, right? And kind of talking to what's actually happening in the markets. I think this is positive and negative. You have obviously the negative, which is Russia announcing part mobilization into Ukraine. So that is an escalation, unfortunately, in the Ukraine-Russia conflict, which is never has a good outcome for anybody, really. Let's be honest. But I think the positive, at least I can think of, is that recently at the SCO, which is where kind of China, India, Iran, a whole bunch of the Shanghai Cooperation Organization get together. Putin was seen as kind of utilizing this as saying, okay, well, our economy is basically going to get everything that we lose to the Western societies is going to be bought up by other, non-Western economies, and that I've got the full support of India and China at the moment. And the word out from that, and also followed on by his announcement this morning of part mobilization, is they're both a genuine and clear signal of annoyance. They made him wait on them for the first time ever, and cancelled a whole bunch of events with him in terms of dinners and the rest of it, and basically told him to say today's era is not an era of war, and please basically stop it. So they will, as you were saying, Arnie, carry on in terms of Modi and Z.
Yeah, that will definitely that will benefit their own countries as much as they can from any source. And if they can get cheap hydrocarbons from Russia, then we can't really begrudge them that. But it's nice to see that they've come out. In particular, Modi has come out and said, "Stop this," because it's just from a humanitarian perspective, it's just horrible. So anyway.
And then also from a pressure internally, where a large proportion of Indians are living at the poverty or below the poverty line, and when you have massive increases to food prices and energy prices, like cooking oil, for instance, it's a staple. He's receiving a lot of, so he's kind of like, okay, enough, wrap it up. And so, I don't know if this part mobilization is that escalation, or is it just to kind of grab a bit of the land and then try and get to the talking? Who knows? I'm not a war specialist. I can just hope I see it as an escalation. I just hope that it all wraps up soon for everybody's case, both humanitarian, economically, geopolitically, everything. Last few is another glorious headline, which is Aussie house prices could fall by more than 30%, which only brings it just under pre-pandemic levels, everybody. So even if they did go through, if you bought a house 5 years ago, you're still up. So if you really bought in the last few years, that you'd be in a bit of trouble. But that's basically saying that some new modelling that's going off the back of a whole bunch of other modelling. I'm not going to read everybody's, but it's Kieran Davis, his chief macro strategist, is off the modelling of Trent Saunders and Peter Chulip and their sophisticated accounts. Blah blah blah. Are saying in line with kind of what banks are saying, 20 to 30%. I think the interesting one though, which Arnie will talk on later, is the immigration story. Probably counter this one. And last but not least for me is
Big Bad Buzzer.
Big Bad Buzzer. Saying there is risk growing in many sectors, the unfettered narrative feeding itself until absurdity explodes, revealing the folly to all and easily starting a revolution.
Wow. Okay, Buzz.
Okay, Buzz. And then his standard, even the chart looks like a heart attack when looking at the Dow Jones.
Oh, my God. He's a little ray of sunshine, isn't he?
He does. He makes me feel good about myself.
But I think the The house price is one in Australia. That's a tough one. But as Jolly would say, tankers, take it all with a grain of salt because the economists very rarely hit the nail on the head. So we'll see what happens in that one. But yeah, you mentioned that other news item which I wanted to touch on in my rapid fire. So cheers, mate. And it was basically that Australia is committed to raising their permanent immigration cap to 195,000 people a year. So what does that mean for us? It means we're going to get more labour in the country, and that means more housing. So hopefully that is a good counterweight to that story you were telling us about, which will be, getting those dwellings up and about.
And also fixing the supply problem is another huge thing about this 195%. And I will say again, not left or right, but the job summit that Albo and his team ran, actually bringing in and listening to people and looking at specific industries, I think it's going to be great for supply side. There could be more done. There's always going to be more done.
Absolutely.
But I think, having a look at, I just think for me, there's a lot of good stuff that's going to be coming out of that.
All right, I love that. I'm going to hit you with my rapid fire news items, and then the last news item, I'll segue for you, Bradle. So, hey, we basically touched on them all. It was basically that China's onshore yuan is weakening compared to the US dollar, and that's been cited as entering the danger zone. We know that
danger zone.
Gunblack has said on CNBC that the recession could be fairly deep if the Fed keeps hiking rates, and we know they're going to. Well, it sounds like they're going to. You mentioned it earlier that Meta in particular, and I mentioned this one because that's one I keep an eye on, tankers. Generally, they should do your own research, but they're cutting 10% of their workforce in the coming months, and they're encouraging those workers to reapply to other parts of the business, which is an odd way to spin this news about cutting their employees. Well, I promised to give some Elon news on every podcast, so I did a quick dig and I couldn't find anything massive, but he has gone to bat for himself and his family about the narrative that they benefited from apartheid, and he's sort of come out swinging against Robert Reich about that. So you can go check that out yourself. And I know we at Money in the Tank are eagerly anticipating the outcome of the Twitter decision in the Delaware Court of Chancery. So that's approaching pretty quickly. I think that's happening mid-October, Braddles. And the last news item I had, which you could maybe add a little bit of flavor to, is that Ethereum has merged and is no longer proof of work. It's now proof of stake.
Hey, finally it's happened. And I think, the good things here is, for those that don't understand the differences, proof of stake will be a 99.6% reduction in energy costs. You no longer will make money from processing the transactions as a miner. You now will make money, if you want to make money, in terms of the staking is by staking and putting your ETH into staking pools, which are then kind of used for validation and kind of returns. It moves it to kind of what I'm going to call the industry standard. Basically now there's very few coins outside of Bitcoin, and there's a few other coins out there, but hardly any coins now that are like smart contract basis or anything like that are not proof of stake. It's kind of when you're a 99.6 reduction. ETH has got the people say, well, with proof of stake, it's the same as proof of work, that, the concentration of too much in one spot is not necessarily good in staking pool, but they're completely kind of diversified in terms of who's holding it and the rest of it. And I think it's just the next step in the right direction of the evolution of kind of Ethereum being, because what it's going to also allow is increased transaction speeds. And so the block doesn't have to be kind of worked anymore. It just kind of, gets allocated and done. And so it's probably going to see some more deflationary pressure, since every block was burning some ETH in the past due to fees and the rest of it. So that's still causing. I think it's just a positive. I mean, the price at the moment is still hovering around $12.50 USD.
The way I view that is like it's a risk, because people were like understandably upset that like it pumped before the merge happened, the price collapsed. I think Ethereum is still a risk asset, although a promising one, and it's going through the same cycle as every other risk asset at the moment, which is we're in a bear market. So I don't
buy the help, sell the news in crypto. I mean, I'll just say across nearly every, whether it's ADA, whether it's Ethereum, whether it's whatever,
or SHIB.
assume. But generally, like when they've got an announcement coming, like it runs and then it happens, and so people sell the news. And that's just generally it's a pretty standard. But people, thought that this was going to be some people believe this was going to be kind of like the reinvigoration of ETH and the crypto markets, and it hasn't turned out to be so. And I think that everyone continues to forget that so much of the top 10, 20 coins are held by institutional investors, not retail investors anymore. And they are a part of a portfolio. And when a portfolio, like when markets are bad and interest rates are going up, and
yeah, exactly,
it's tight, right? And so until it decouples, you're not going to see much. But I think it's a positive step for the journey of Ethereum and crypto as a whole. So.
Love it. Well, that's it. That's us for the week. But I got a 50-50 for you. Actually, it might even be more appropriate to call it a third this week. And it's one I've been thinking about recently because my own tastes have changed. But I wonder, Braddles, do you prefer... It's like, how do you prefer to eat your eggs? And I know there's more than 3 ways, but I'm going to hit you with fried eggs.
Okay, throw Suvide in there.
Fried eggs, poached eggs, or scrambled eggs. If you had to choose, and Tankers, the reason we do this is to highlight that as an investment, as in life choices, people have differing opinions, and that's okay. So I want to know.
You can also ask information related to for the choice. Am I eating out? Am I at home or am I at a restaurant?
All right, let's just say we're at a restaurant where they are making the eggs, all 3 of the egg styles to perfection with all the accoutrements that you might want. So they're all perfect in every way, shape,
and are we just having eggs on toast, or is there other things?
Yeah, no, there can be anything. Like it could be it's an egg dish. So yeah, it's like, which one do you prefer?
I'm gonna go. I would say I used to be 100% when eating out a poached guy.
Mm-hmm.
I would say that restaurants in Melbourne now have learnt more of a French style of cooking scrambled eggs now, where they're silky, and so I'll go scrambled. I think there's scrambled with a bit of spanner crab and stuff.
Scrambled, okay. See, I love a good scramble, and when I'm making it at home, I tend to go for a scramble because
I was used to be the same, but now that restaurants are doing it better.
Yeah. But so when I'm out, I like to get the poached eggs. And typically, when I get the poached eggs, I want them as part of a wider dish, like an eggs Benedict or avo on toast with some nice poached eggs. So I don't know, man. There's some bloody good ones out there.
See, at home, I've moved. I used to be a scrambled man at home. Now I'm a fried man at home.
Ooh.
And I used to be a poached, and now it's investment choices, aren't they? They change. So we're talking about at the start of the show. We're talking about how nice it is now that, like, I guess our investment horizons are. We don't worry about what happens day to day and in the markets and the rest of it, because now the only thing we rely on is kind of our own choices about where we think kind of an industry or a stock is heading.
It's the way. It's the way to be. You can get caught up in this short-term news cycle. There's always something bad happening. Jolly pointed out a couple of weeks ago that if you look at the history of the Australian stock market, there's always a crisis on the horizon or happening. If you just, general in nature, but if you buy good companies, you hold them through a long enough time horizon, you're going to do okay.
And as I say to everybody, if those good companies go bankrupt and like the whole economy falling apart and like the whole financial institution, there's going to be more problems worrying about than your superannuation money.
Oh, absolutely.
I always just say that to like make myself like just remember that like people are like, but what about the entire financial collapse and the whole world falls apart and the rest? I'm like, you think I'll be caring about my stock losses at that point in time?
Bigger problems.
Well,
that's 46 in the books. We're closing in on the magical 5-0 where we're going to raise the bat. So I'm pretty happy.
Yeah, it's awesome, mate.
Good one, mate. I'll catch you next week, eh?
Matey. Have a good one.
See you, mate.
Bye.